time frame there, that's when, in the case of soybeans, when the planted acreage figures and stocks figures came out. You have another one here when the crop report for August came out, another one here when the crop report for September came out. So those are some big candles that you have to work around and kind of worry your way through. Noteworthy is that tomorrow, Friday, September 30th, over in here we have another stocks report, and that could be another market mover, and we'll talk about that a little bit. We also had a hogs and pigs report that came out yesterday, and you may not follow hogs and pigs, but that's the key consumer of soybean meal. And so when you're looking at soybean meal, and you got to think about the aspect of demand as being kind of a key factor with what's going on in the markets, when you have the influence of the stronger dollar, when you have the risk on, risk off type of attitude, every market is going to have some influence from all those other markets. And so you have to consider that in trading soybean meal, or whatever market it is that you happen to be trading that is going to be priced in dollars. Now we're going to cut back the time frame here and look at the standpoint of only the last 3 months. Well, first of all, let me point out one other thing about this, about the predicted differences when we're looking at it. I'm going to cut back all the way back to a year here, and you will notice when I push this vertical or the horizontal line across there, you will see that the predicted differences, when they get up to about +10, they tend to turn back down. And if you'll see where the prices are above them, that kind of indicates a peak. It's kind of like an overbought type of situation that you can see with some of the other indicators. And when it gets to +10, or almost maybe it's a little bit less than 10, -10, but in the vicinity of -10, that indicates the weakening situation when the market is potentially likely to turn. It's just kind of one of those alert type things to be aware of where those lines are. There's no limit. They can go quite a bit higher and go quite a bit lower. As you can see here, they did drop below this -10, and it could keep on going. There's no way of saying that this is the turn. It's not automatic, just as it is with some of the other indicators. They don't automatically turn because some threshold has been hit. But it's kind of an alert to be aware of the possibility of a turn type situation. Okay, now we're going to cut back and only look at 3 months worth of time, because we need to look at some of the indicators a little bit more carefully and see how we would play these. We're going to add one other indicator from Vantage Point, and that is going to be the predicted high and the predicted low. Now these are predicted highs and lows for the following day. When we look at the predicted high and the predicted low, you can see that on the screen here. We have the gold line, or the orange line if you prefer. That is the predicted high, and we have the predicted low is that pink line, or some would call it fuchsia line. You can see that we also have a line at the end, which is the predicted high and low range for today. We don't have today's data in there, of course, obviously, but that's the predicted high and predicted low for today. Sometimes those prices are going to be pretty much on, and sometimes they tend to not be on. But that's kind of going to be our key in terms of using a strategy to set up a strategy for trading in the various markets. I mentioned we had this kind of a crazy day here when you have the crop reports and things happen. Very hard to determine whether you would have gotten in or out at a given time, simply because it's kind of a crazy type of day, and then limit up the way the ag reports are released. You have a release on 7:30 a.m. in Central Time. Trading starts at 9:30 a.m. Central Time, and you have that big gap time in there, so you're subject to limit up and limit down moves, and you never can be sure, especially this year, which way those are going to be. So kind of a high risk time, and you may or may not want to be involved simply because of the potential risk from the report, from that fundamental type of factor. But looking at what we have here with a couple of different time periods, we're going to just consider a couple of things, and we're going to also get into a couple of other markets, the E-mini and the Euro in a bit. But looking at it from the standpoint of kind of an instruction from the theoretical nature anyway, you have a situation here where the predicted high, this is on the 1st of September, I believe, the September 1 predicted low, that pink line you see there, was 385.30. So we need to figure out if the market is trending, you can see that we have a situation, if you look down below, where the predicted differences have started to turn over. The market hasn't turned exactly yet, but we're getting into the point where the next day after that, you have the predicted neural index drop to 0, which is bearish. You have some things coming together that are of a bearish nature. You also have a doji top candle top. When you look at this candle, a doji is indicating uncertainty, where the market opens, closes at about the same level, trades on either side of it. Sometimes that the tail can be pretty long, indicating traders have rejected a price if it's too high or too low, and they return to a point where they started the day, and that suggests some uncertainty, and quite often is another one of those alerts that you get for potential top. Also on the bottom, but better, more likely, more reliable as a top side indicator. In this case, in the September meal situation, I'm using as my gauge here as to whether I will buy or sell, above the predicted high or below the predicted low. I'm going to use the an average daily range that is in the market of $6 a ton. Now, it can vary. If the market is very volatile, you get some bigger, wider swings. You might have, an average daily range, and this is, again, it's a rough approximation of the average daily range. It could be 8, it has been. It could be 10, could be 4, whatever. But just kind of arriving at more of a, or less a kind of an eyeball type figure. $6 is going to be my range at which I will sell if it drops below or above the predicted high or predicted low. In this case, September 1, we had this situation here where we had the predicted low was in the neighborhood, as I said, 385.30. So if I'm going to sell $6 below that, I don't want to get in there too soon because I want to like to see this market be turning. And so I'm going to put it $6 below that at 379.30. Now at 379.30, it takes a little bit before that actually gets hit. We have to go over here to a bar, or a candle rather, about 3 or 4 days later, September 6th, and we were then in the market in a short type of position. If we get filled at that price at 379.30, we're going to keep a stop $3 above that entry point at 382.30 as our exit. The reason for that is we want to keep the risk rather small. In the case of the soybean meal contract, if we put a $3 limit on it, it's $300. That may be a little bit too tight. All depends on the market, on the conditions, various other things that weigh whether that will be the correct amount. But I'd like to keep risk small if I possibly can. So I'm going to put that risk at only $3. That means that I would then get stopped out at 382.30 if it bounces back. In this case, I've mentioned this in prior webinars, so if you have heard this before, sorry to repeat, but we had some fundamentals. We had drought, we had threats of freeze, we had other things going on from a fundamental side that said, nobody wants to be short in those kind of conditions. And so you may have been one of those. You may have said, I'm not buying this signal, this technical analysis signal, because I know the fundamentals indicate that we could have a sharply higher move. But let's assume that you did, stick